This video is brought to you by BlackNote Investment, the equity research platform where you can find all the necessary data for company valuations. The software industry comprises all those companies that develop, distribute, and maintain software products and services. The software industry can be divided into three sub-segments: companies operating in the cloud computing segment, companies operating in the cybersecurity segment, and all other companies developing specific software solutions for other niche segments. Cloud computing, from now on simply cloud, refers to the on-demand availability of computer resources, mainly for data storage and computing power, without the need to physically own or actively manage the computer hardware and, in most cases, even the software. Thanks to cloud services, the organization can move its workload from the on-premises computer, better called servers, to the cloud. Cloud servers are dedicated computers located in data centers, placed in different locations all over the globe, and managed by cloud provider companies. Cloud providers are companies that set up the data centers and offer their servers, hence computing resources, to third parties that, for example, need those computing capabilities to run applications or to store and process data. The third parties then pay a fee to the cloud providers, usually based on the amount of computing power they use. This service is called computer as a service. The primary benefits of moving the workload from on-premises servers to the cloud are a significant reduction in upfront capital expenses to purchase and set up IT infrastructure, such as hardware and IT maintenance operating costs, as well as a significant reduction of operational risks, as relying on cloud servers eliminates the risks of failure of on-premises hardware due to power outages or damages to hardware components. The second benefit of cloud solutions is a greater scalability, whether up or down, of computing resources. If with traditional on-premises servers, a company would usually have to wait for the procurement team to purchase a new server, and then wait for the IT team to get it up and running. With cloud computing, the company can instantaneously and unilaterally increase its computing resources by increasing the usage of service time or network storage. On the other hand, if the computer resources are no longer needed, with cloud solutions, the company can immediately and unilaterally reduce usage of service time or network storage, reducing operating costs, while with on-premises servers, the company will likely continue incurring in maintenance and obsolescence costs. Essential solutions leveraging on cloud services are compute power, data storage, access and management of databases, data warehouses and data lakes, data analytics, machine learnings, access management, and customer engagement and relationships. Cloud services companies usually offer their solutions under three different models: infrastructure as a service, platform as a service, and software as a service. With the infrastructure as a service model, cloud providers will manage the servers, data storage, virtualization, and cloud networking, while the client will maintain control and ownership over middleware, operating systems, and software applications. Virtualization refers to simulated hardware in a virtual environment. Instead of having multiple physical servers running different applications, an organization can set up a unique server running different applications using different virtual machines, each with dedicated software. A hypervisor is the software used to create virtual machines and is in charge of allocating and controlling servers' resources, like RAM and CPU. By leveraging virtualization, organizations eliminate the costs needed to set up hardware and maintain it. Also, thanks to VMs, servers' computing capacity is maximized. However, VM drawback is that they consume a lot of storage, RAM, and CPU resources. To overcome this problem, so-called containers can be used. Differently from VMs, containers only include the application that needs to be run, bundled with all the features needed to run it. Containers can be hosted in any server without requiring additional hardware or software, which would take resources from servers, resulting to be way faster and cheaper to operate than VMs. With platform as a service model, cloud providers will manage the servers, data storage, virtualization, cloud networking, operating systems, and middleware. The client will maintain control and ownership only over the software applications they choose to deploy on the cloud platform. With the software as a service model, cloud providers will manage the servers, data storage, virtualization, networking, operating systems, middleware, and software applications. The client then will immediately have access to up-and-running software applications without worrying about hardware capacity or software development. Cloud solutions can be private, operated solely for a single client, and are usually very capital intensive as they still require significant hardware but permit full control over sensible data. Public, shared by multiple customers, and very flexible, as it is usually priced on a pay-per-use basis, or hybrid, leveraging on a mix of private and public solutions. Multi-cloud instead refers to the use of different cloud services from different cloud providers, reducing the reliance on single vendors and avoiding the so-called vendor lock-in effect. Cloud vendors apply significant egress fees or exit fees to reduce the portability of workloads from cloud to cloud, locking clients within the vendor's cloud environment. Cloud companies can be divided into two main categories: cloud providers and cloud services companies. Cloud providers like Amazon Web Services, Google Cloud Platform, Microsoft Azure, Oracle Cloud, Alibaba Cloud, and IBM Cloud provide the full spectrum of IaaS, PaaS, and SaaS solutions, usually under a consumption-based model with fee revenues depending on how much clients use service time and network storage, or under a more traditional subscription plan. Cloud providers' business model is notably capital intensive, as it requires significant upfront investments to set up data centers and networking infrastructures. However, given the remarkable investments, the segment is characterized by a high barrier to entry, with only 3 players, namely AWS, GCP, and Azure, controlling the whole market. Cloud services companies instead, like Salesforce, ServiceNow, Nutanix, GitLab, and UiPath, usually rely on cloud providers' infrastructure to deliver specific SaaS solutions tackling different customers' needs. Revenues are mostly collected on a subscription basis, even though some players offer pay-as-you-go payment models. Cloud services companies are far less capital intensive, with primary operating costs represented by fees paid to cloud providers to access their infrastructure. Due to the significantly lower barriers to entry, the segment is highly competitive, as new players with relatively similar solutions can easily access the market and rapidly conquer market shares. Other than pure cloud services companies, there are companies like Cloudflare and Fastly, offering content delivery network solutions, which, despite offering SaaS solutions to their clients, must invest in network infrastructure and maintain it to deliver its solutions. At the same time, however, they might still rely on cloud providers for critical cloud infrastructure. Revenues are usually recognized on a consumption-based model. Cybersecurity refers to the protection of computer systems from malicious attacks in the form of hardware and software damages, theft of data, leakage of private information, or disruptions of operations that might result from systems vulnerability. Thanks to cybersecurity solutions, organizations can individuate vulnerable systems in time and prevent cyber attacks. Examples of the most common cyber attacks are: backdoor represents any method of bypassing normal authentication controls to access private networks. Denial of services and distributed denial of services are attacks aimed at making computers and networks unable to perform their tasks and services. While DOS are easier to identify and block, DDoS coming from multiple IP addresses are more difficult to counter. Malware are malicious software with the objective of damaging computer systems by leaking, corrupting, or damaging private information, passwords, and data, or worse, giving control of computer systems to hackers. Ransomware is a type of malware which firstly corrupts computer systems to then demand a ransom to obtain back the control over the system. Malware usually takes the form of computer viruses, which contain malicious code that once opened hijacks software and copies itself to infect more computer systems. Man-in-the-middle refers to an attack from malicious third parties intercepting a communication between two parties. Phishing refers to the attempt to obtain sensible information by misleading its owner into sharing them, usually by emails and messages. Computer security is measured by 3 processes: threat prevention, detection, and response. Threat prevention is the most crucial aspect and can be achieved, among others, through cryptography, known as the implementation of protocols that prevent third parties from accessing private information. Endpoint security, referring to the protection of computer network from attacks arising from wireless devices such as smartphones and laptops. Firewalls, which are network security systems that act as a shield to block malicious attack to the system, both in the form of software and hardware. And zero trust security models, where by default, the system do not trust any device and users, even if connected to the organization's network or already previously identified. Detection solutions instead comprise intrusion detection systems like extender detection and response solutions, which are used to detect real-time attacks on the systems. Finally, response, such as the intervention of anti-malware or antivirus, comprises all set of counteractions initiated to mitigate the damage and report the attack after a menace has been detected. The cybersecurity segment is composed of legacy cybersecurity companies like Palo Alto Networks and Fortinet, usually boosting a broad range of cybersecurity solutions, both hardware and software, sold under a license or subscription model, and cloud-native cybersecurity companies comprising younger players like CrowdStrike, Zscaler, and SentinelOne, completing leveraging on the cloud to offer SaaS solutions under a subscription model to modernize the way organizations approach cybersecurity. Other than cloud computing and cybersecurity companies, the software industry is fragmented into several niche markets, where software development companies target specific customers' needs like Adobe and Synopsys, offering creative and design software, Zoom Video, offering communications and collaboration software, AppLovin, offering marketing and sales software, Intuit, offering financial software, and Unity Software, offering software for the gaming and 3D industry. Despite not all companies directly competing in the cloud computing segment, as seen in the cybersecurity segment, after the advent of the cloud, almost the entirety of software companies have switched their revenue and delivery models towards a more SaaS-oriented subscription model to leverage the immense benefits of the cloud. From 2013 to 2023, the industry's revenues grew at a CAGR of 10.4%, increasing 2.7 times from $235.3 billion to $635.1 billion. As of 2023, the industry's operating margin stood at 25.3%, reflecting inline performance with the industry median value of 22.3% of the past decade. The total operating profit was $160.5 billion. Looking at other measures of profitability, in 2023, the gross margin sat at 70.3%, better than the median value of 67.4%, while the free cash flow margin was 8.2%, slightly worse than the past decade's median value of 10.7%. Collectively, in 2023, the free cash flows to the firm registered a value equal to $51.8 billion. As regards solvency ratios, the debt-to-enterprise value ratio for the software industry is 2.4%, while the debt-to-equity ratio is 15%. The interest coverage ratio instead, showing how much the operating income covers interest expenses, is critically low at 0.56, which would translate into a credit rating for the software industry equal to C based on Moody's rating standards. Finally, the unlevered beta of the software industry, which is the beta depurated by the debt leverage, has been 1.13 for the past 2 years and 0.85 for the past 5 years. The software industry is moderately concentrated, registering a Herfindahl-Hirschman index of 14.5 or 1.447 points. The Herfindahl-Hirschman index is used to measure the level of competitiveness concentration in an industry with HHI below 0.15, indicative of unconcentrated or very competitive industries. HHI between 0.15 and 0.25 indicative of moderately concentrated industries, and HHI above 0.25 suggesting that industries are highly concentrated or scarcely competitive, like oligopolies. However, when considering the 3 subsegments composing the industry, the cloud computing segment, accounting also for cloud revenues generated by non-software companies like AWS and Google Cloud, is the most concentrated, registering an HHI of 0.231, while the cybersecurity segment results to be more competitive with an HHI of 0.137. The following table provides a snapshot of the top 22 companies in the software industry, accounting for 75% of total market share by revenues. As regards the 3 subsegments, cloud computing accounts for 60.3% of the total market share, exclusive of the cloud revenues generated by non-software companies like AWS and Google Cloud. Otherwise, the total market share will adjust to 68.1% when adding cloud revenues generated by non-software companies to the total. The cybersecurity segment accounts for only 4.5%, 3.6% when considering non-software cloud companies, while the remaining 35.2% of revenues are generated by companies operating in other niche segments. Although the blossom of cloud and cybersecurity solutions benefits the software industry, over the past years, concerns for data protection and individual privacy protection have risen among governments and international institutions. This led to the introduction of stringent regulations and frameworks that software companies must comply with to ensure the protection of both their clients and their clients' customers' data and information from any potential threat. Examples of regulations firms are obliged to comply with are data protection and privacy regulations like the EU GDPR and the Californian CCPA, cross-border data transfer regulations like the EU-US Data Privacy Framework, providing a detailed mechanism for the transfer of personal data from the EU to the US cybersecurity regulations, a set of policy frameworks for computer security on how organizations can prevent cyber attacks like the NIST Cybersecurity Framework and EU Network and Information Systems Directive. The blossom of the Internet at the beginning of the 21st century and the mass adoption of cloud computing have been two major drivers for the rapid expansion of the software industry. Nowadays, given the ongoing digitalization trends and sprout of AI technologies, software solutions are embedded in people's everyday lives more than ever. To capitalize on such opportunities, over the past decade, collectively, the industry registered a median reinvestment margin of 18.4%, which comprises investments made in capital expenditures, R&D, and acquisitions. In terms of efficiency and return on investments, the software industry median sales to invested capital in the period 2013 to 2023 is equal to 0.76, meaning that on every dollar invested, the industry generates 0.76 of revenues. Combining both the reinvestments made through the past decade and the industry's ability to generate a return from the investments made, the 2024 expected growth rate for the industry is 14.07%. A detailed explanation of how we came up with the industry's expected growth rate, as well as many more useful industry data, can be found on my website BlackNote Investment. Among all 37 industries analyzed on our equity research platform, the software industry places third among the fastest growing industries, only behind the interactive media industry and the semiconductor industry, boosting a 2024 expected revenue growth rate of 15.4% and 14.9% respectively. By 2033, the software industry revenues are expected to reach $1.4 trillion, increasing 2.2 times from the $635.1 billion registered in 2023 at a CAGR of 8.2%. We projected the industry's expected revenues 10 years from now, applying the expected growth rate of 14.07% and allowing it to slowly decline as the industry approaches the economy's perpetual growth rate, represented in this case by the USD risk-free rate. If you're looking for financial data to support your valuations, on BlackNote Investment, you can find the expected growth rate for 37 different industries used to forecast companies' future revenues. Additionally, the site offers useful data such as equity risk premiums for 39 different countries, used for calculating discount rates, as well as expected earnings growth rates for those countries based on analysts' expectations. Detailed industry and sector reports are also available, containing data like total revenues, total free cash flows, median operating margins, return on capital, as well as beta and financial ratios used to assess companies' risk. Feel free to use them in your analysis.